All right, so this will be our last lecture video for chapter 16. I guess it'll be lecture video number 6. So what I forgot to do at the beginning of chapter 16 was to do what I've done with the other chapters and show you some financial statements of Kroger and Tesla and Twitter. Again, 3 different companies, have some similarities, have some differences. I think it's worth looking into how they present things on their financials. So Kroger, here is their most recent, at least one class started, income statement. So it's for the year ended February 2019, and we can see they've got net earnings attributable to Kroger. So we've talked about this before. They've got some non-controlling interests. They've got some other parties that have an interest in Kroger, but for the most part, for common shareholders, we see here that their net earnings are $3.1 thousand million, so $3.1 billion of profit. It's a lot of money. And then they've got their per share amount. So they list the basic common shares. So 3.1 billion of profit. It's $3.80 per share. On the prior 2 years, it was $2.11 and $2.08. So a lot of growth in 2019. And they also report the number of common shares. So this is their WANSO, basically, for 2019, 810 million shares. And then they've got net income available per diluted share. It's 376, and of course you can see it's lower. And so they've got 818 common shares, 818 million common shares in that calculation. And of course, as is always the case, the accompanying notes are an integral part of the consolidated financials. So if you want to know more detail, you go to the notes. And so here is their note for common shares. So I've highlighted in green and yellow just to separate the two because of the way they're written here. So for the basic shares, it's net earnings attributable to Kroger less income allocated to participating securities. So this is again, something that we're not going to cover in this class, but it's basically net income available to common shares divided by the weighted average number of common shares. That's your WANSO right there. And then for diluted common shares, it's in green here, it's net earnings less income available allocated to participating securities divided by a weighted average number of shares after giving effect to dilutive stock options. That's the stock options thing that I covered in, or the warrants and options piece that I covered in the last video. And then we see a little bit of detail of calculation here. We see actually not very much when you look at it. 810 million shares in the denominator, 8 million shares for stock options, and then you add that. Kroger does not have the most complicated equity section. You might remember that there's no preferred shares outstanding. Actually, there are no preferred shares standing in any of the companies we're looking at. So we don't have to worry about preferred dividends up here. And they do give you a little bit of detail about shares that were excluded because their inclusion would have had an anti-dilutive effect on net earnings. So again, go back to video 5 when we talked about warrants and options that would not be exercised because the exercise price is higher than the market price, or because or alternatively, because exercising them, management would have been able to buy enough treasury stock to completely reduce the dilution effect. Their next note is on stock option plan, so that's the end of that. All right, so Kroger, fairly straightforward. They just kind of report these changes. Tesla, let's see, Tesla's balance sheet or income statement's on page 76. So here's Tesla's statement of earnings. Everything is in thousands. So Tesla has a net loss of 679 million and a billion, and 900, almost a billion, so a billion. And notice all of their basic and diluted are the same. If you dilute a net loss, the net loss gets smaller per share. And so Tesla does not include any of the dilution because, remember, accountants are pessimists and accountants are playing worst case, let's pretend. And if we tried to include any dilution in here, it would actually make our loss per share smaller, and that would make, a small loss is better than a large loss. So that would actually make things look better for shareholders, and so those would be excluded. And so let's see if I can get this to fit a little bit better. All right, so net loss. Here, Tesla includes their net loss calculation in their summary of significant accounting policies, which is a little bit different from the other two, but it might be because they don't actually have any dilution to report. But they do say basic income is dividing net income to common shareholders by the weighted average shares outstanding. So that's one. So potentially dilutive shares, including yada 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 yada, are included when their effect is dilutive. So that's what they're doing. They talk about how they plan to settle some convertible notes. How they calculate the dilutive effect there. It says, furthermore, in connection with offerings of our bond hedges, we entered into these. However, our convertible note hedges are not included when including potentially dilutive shares, since their effect is always, let me get to anti-dilutive. All right, so if you've got hedges, you've got more complicated stuff going on with your notes, or with your convertible notes. You'd have, different ways of calculating than what we came up with, that we talked about in class. They also show here, and this is something that has to be reported. Kroger did this, and they're doing it too. A number of potentially dilutive shares that were excluded from dilution because they're anti-dilutive, and so they stock-based awards, convertible notes, and warrants. So all the things that could have been included if they were dilutive would have been included. Now I'm guessing. I remember in 2019, Tesla reported a net profit. Once they start reporting a net profit, assuming they do, then they're going to need to include some of this dilution in their diluted EPS. And then Tesla or Twitter, same thing. Actually, they're in thousands again. They've got basic and diluted EPS. They've got losses in the first 2 years, but they've got a profit in 2018. And because of that profit, they actually do show the dilution here. So in 16 and 17, they don't want to dilute a net loss. And in 18, we do dilute the net profit. And in their common stock and in their stockholders' equities, where they report net loss per share. All right, so again, they have the same description of how they calculate net loss per share. And again, they talk about things that were not included because they're anti-dilutive, and then they've got their calculation of basic earnings per share. Now they've got restricted stock. Again, we didn't cover restricted stock in this class, but those are shares that are outstanding, but they might have to be repurchased by the company if certain conditions aren't met, and so that would reduce the number of shares outstanding. So in that case, but again, this is not diluted. This is still basic, so we don't have to play let's pretend worst case scenario. So that gets us to the basic earnings per share. And then notice in the 2 years where they had losses, they did not include any dilutive securities, because that would have reduced loss per share. And then they mentioned all the things that were excluded because they're anti-dilutive. And that's that. So Tesla, Twitter, Kroger are doing what we talked about in class. Again, there's a little bit more detail on what's going on than what we're going to show in an intermediate level accounting class, but the same basic principles are there. Now, you might be looking at this and saying they've got multiple potentially dilutive securities here, and this year they've got multiple securities that are actually being included in their dilution. How would Twitter handle multiple dilutive securities? So you'll note in the examples that we covered in class, everybody only had one dilutive security to consider. Now, there's an appendix in Chapter 16, and that covers multiple dilutive securities. The upshot is what you do is you take each dilutive security and you rank order it in terms of which are most dilutive to which are least dilutive. In other words, which one will have the greatest reduction in your earnings per share to the ones that have the least reduction in your earnings per share. And you include those one at a time, and you include each one and you recalculate EPS. Then you include the next one and recalculate EPS, and you kind of keep adding them in one at a time until you get to the point where you start having anti-dilution, and then you stop and you don't include that one. So you can look at Appendix B in Chapter 16 if you want that, but what I What I want you to know at this point is you have you just rank order them and you add them one at a time. And doing that includes the most possible dilution in your earnings per share, and it gets it to the worst case scenario that's possible. All right, so that's my sort of recap of earnings per share and dilutive securities. So that's my recap of Chapter 16 with Kroger, Tesla, and Twitter. I hope that's helpful. Please let me know what questions you might have.